2024 Investment Outlook. Is there a comeback in sight for bonds? Let's talk about today's news and migration world. At the opening of 2024, it may appear many investors are skipping to the beat of Timbuk 3's 1986 hit single, "The Future's So Bright, I Gotta Wear Shades." As of December 27, the American Association of Individual Investors Investor Sentiment Survey showed that 46.3% of investors had a rosy outlook for equities in the coming 6 months, and only 25.1% had a negative outlook for equities. That's quite a shift in the sentiment from early November, when only 24.3% had a bullish outlook on equities and 50.3% were bearish. Further, more than 6 in 10 institutional investors say they are optimistic about what lies ahead for the market over the next 3 years, according to data from Boston Consulting Group's 2023 Global Investor Survey. And who can blame investors for such a sanguine outlook? The Big Mo appears to be on their side. In November, the S&P 500 Equities Index notched about a 9% gain, according to data from S&P Global. As of December 29, the S&P was up 24.2% year-to-date. Zoom in closer, however, and you'll also find some shades of gray on the horizon for the market in 2024. Natixis 2024 Institutional Outlook Survey, which polled 500 institutional investors from 27 countries, including the US, found experts have their eyes peeled for elevated portfolio risks, from interest rates, 62% see rates as a key portfolio risk, to inflation, 61%, and market volatility, 45%. While the U.S. economy has been very resilient in the face of the rapid increase in interest rates, we believe the economic headwinds of higher rates are inevitable and that markets are too sanguine about the prospects for the U.S. economy in the coming year, says Spencer Smith, head of institutional investments for Chevy Chase Trust Investment Advisors. All eyes on the Fed in 2024. In December, many investors welcomed the Federal Open Market Committee's unanimous decision to hold rates between 5.25% and 5.5% and signal some rate cuts in 2024. The Federal Reserve's so-called dot plot in December suggested a median Fed funds rate of 4.6% in 2024, followed by 3.6% in 2025 and 2.9% in 2026. Following the committee's decision, Federal Reserve Chair Jerome Powell added, "While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic and ongoing progress. The markets seem to expect more from the Fed in 2024. The CME Fed Watch tool, which monitors the futures markets, suggests rate cuts may reach 125 basis points next year. This would lead to a Fed funds rate range of 4% to 4.25% in 2024. Kim de Dominicis, portfolio manager of the target date strategies in the multi-asset division at T. Rowe Price, says, "Not only are markets trying to anticipate the impact that the rate hikes have already had on inflation and employment, but they are also trying to figure out when and how much the Federal Reserve will cut rates in 2024. Vanguard expects the Fed to pare back rates to the 3.5% to 4% range in the second half of 2024. But we're not heading back to 0% rates, those days are behind us," says Roger Aliaga Diaz, chief economist for the Americas and global head of portfolio construction at Vanguard. "We expect that the higher interest rate environment will last for years, a structural shift that will endure beyond the next business cycle. This is the single most important financial development since the global financial crisis." Will bonds make a comeback? The past 2 years have been rough for bond investors. As the Fed hoisted rates off of historic post-pandemic lows, some bond investors experienced drawbacks of nearly 15%, according to data from Hartford Funds. The Morningstar U.S. Core Bond Index, which covers an array of government and investment-grade corporate bond markets, plummeted 12.9% in 2022 alone, the index's largest annual loss since it began tracking fixed income back in 1999. Still, if history is our guide, there could be a comeback narrative in the works for bonds. The context is reminiscent of the Rocky II storyline. Bond valuations were taken down to the mat in the last 2 years, but don't expect them to stay there. Take intermediate bonds, for example. Following the last 5 rate hike cycles from 1995 to 2019, intermediate bonds have bounced back by an average 1-year return of 11.55%, according to data from Hartford Funds and Bloomberg. Bonds have an inverse relationship with interest rates, so bond valuations fall when interest rates move up, and vice versa. So, if the Fed begins to cut interest rates in 2024, that could have a positive impact on bond valuations. Nobody can have certainty in today's outlook. But over the next 12 months, high-quality fixed income has the potential to provide attractive opportunities from both a yield and total return standpoint, supporting its traditional role as a ballast within diversified portfolios, says Chitrang Parani, fixed income portfolio manager for Capital Group. Aliaga Diaz says, our bond return expectations have increased substantially. We now expect U.S. bonds to return a nominal annualized 4.8% to 5.8% over the next decade, compared with the 1.5% to 2.5% we expected before the rate hiking cycle began. Similarly, for international bonds, we expect annualized returns of 4.7% to 5.7% over the next decade, compared with a forecast of 1.3% to 2.3% when policy rates were low or, in some cases, negative. Soft landing versus recession in 2024. The potential lagged effect of the Fed's 11 rate hikes since March 2022 may shape the investment themes of 2024. Will inflation continue to abate? Will investors focus their attention on slower growth prospects in the U.S., or will they anticipate higher growth prospects that are typically generated by steep rate cuts? Will the U.S. economy muddle through this adjustment period without entering a recession? The muddle-through view could be a catalyst for broadening of equity market participation, and bonds could do well should rates move lower, albeit supply could weigh on the longer end of the curve, says De Dominicis. Cash yields could become less compelling versus riskier assets and extending duration, which could move some of the money off the sidelines and back into the markets. In a December 2023 CNBC Fed survey, polled economists estimated there was a 47% probability that the U.S. will experience a soft landing and a 41% chance of a recession in 2024. Thank you for watching the video. If the video was helpful, make sure to like, share and subscribe to this channel for the upcoming videos. See you in the next video.